Well, good morning to everyone in Eastern Europe. Thank you for joining us for this World Council of Credit Unions COVID-19 Response Committee webinar, a virtual Central and Eastern European Financial Symposium, the economic impacts of COVID-19 on credit unions. We are co-hosting today's event with the National Association of Cooperative Savings and Credit Unions, our direct member organization in Poland. We've got a great agenda today. We'll have an introduction from Rafał Maciej. He is the chair of World Council of Credit Unions Board of Directors and also the CEO of NACSCU. That will be followed by opening remarks from Pavel Peltz, coordinator of the Regional Credit Union Center. After that, the impacts of COVID-19 on the economy of Eastern Europe, a presentation from Vasily Astrov. He is an economist at the Vienna Institute for International Economic Studies. Then we'll have a presentation on the credit union system in Poland from Maciej Ruczynski, Vice President of NACSCU, and Krzysztof Chmura. He is the operations head and treasurer for NACSCU. Finally, a presentation on COVID-19, European financial markets and the economy from crisis to opportunity. That is a presentation by Rafał Boguslawski, Director of Strategy and Development and Savings Products at Analizy Online SA. After that, we will have a question and answer session with Rafał Boguslawski. Just a housekeeping note for you. If you have any questions for our speakers, please use the Q&A button at the bottom of your Zoom screen and type them there, and we can ask them of the speakers as time allows. So we are going to start now without further ado with Rafał Maciej. He is the chair of World Council of Credit Unions Board of Directors and the CEO of NACSCU for introductory remarks. Rafał?
Thank you, Greg. I hope you can hear me and see me good. I cordially greet all of you to the inaugural RCUC, so Regional Credit Union Center Symposium. And I am glad that you are with us. On behalf of the Global COVID-19 Response Committee of the World Council, the webinar is to inform credit unions about economic and financial trends, how those trends are affected by COVID-19, and what this implies credit unions for their planning for 2021. The regional center is a joint initiative of World Council of Credit Unions and Polish National Association to exchange information and good practices between credit union systems from the region. So it is an initiative to help each other, and today's symposium is one of the ways to help each other. The aim is to support the development of credit unions and stimulate their growth and importance on the market. I hope you will be interested in the topics we have prepared for today. Let me give the floor to Pavel Peltz, the coordinator of the regional center, who will introduce us to the program and the speakers. Thank you for your attention and have a good meeting. Thank you very much.
Thank you very much, Rafał. It's my pleasure to be together with you as Regional Credit Union Center Coordinator. That's my first attendance as in this role, as I became a coordinator a few months ago, and due to COVID-19 there was no opportunity to meet with you face to face, so that's why we are using web technology thanks to cooperation with WalkU, which allow us to use their Zoom technology, and they are taking care about all technical details. in my opinion, it is very important to exchange opinions in our Central and Eastern Europe region. I hope that in the future we would be able to add to this webinars or online meetings also meetings face-to-face, but unfortunately we have to wait some time to solve this COVID-19 problem. And of course, the COVID-19 problem is also a starting point for our presentations, which we are going to have today. Two of them are related to economic issues, the first one and the last one, and in between you would have a presentation in which we will try to show you how the NACSCU in Poland was trying to adapt to COVID-19 situation, and what this situation was taken also as an advantage, not only as a danger and risks. And that is, I think, also an interesting topic for or of us. It's my great pleasure to give floor to our speakers, and I hope you will enjoy this presentation as well as the whole seminar, and I hope that we will meet in the future in similar webinars as well. So thank you very much.
And thank you, Pavel. And it was good to hear that, you know, RCUC is now reaching out, and I know they have been reaching out, and you can finally connect with some folks that perhaps you were unable to before. So up next, we are pleased to be joined by Vasily Astrov. He is an economist at the Vienna Institute for International Economic Studies and a country expert for Russia and other CIS countries. His research focuses on macroeconomic analysis. He is also the editor of the Institute's monthly report. And in his recent research, he has analyzed the economic effects of the global crisis and also on European energy security issues. Vasily, welcome, and you have the floor.
Thank you, Greg. So, ladies and gentlemen, it is my pleasure. It is an honor for me to present our analysis of the economic impact of the COVID crisis on Central, Eastern, and Southeastern Europe. So in my presentation, I will talk, first of all, a lot about the impact during the first wave of the pandemic. And later on, I will come to the issues of economic forecasts. So what is our assessment for this year as a whole, and what are our projections for 2021 and 2022? First of all, I would like to start with the economic impact of the COVID pandemic in the second quarter of this year, which was basically the time of the first wave of the pandemic. So a large part of the second quarter was basically the time of the peak of the first wave of the pandemic. And in this chart, you can see the economic development, the dynamics of real GDP on an annual basis. So by how much real GDPs of countries of Eastern Europe fell in the second quarter on an annual basis. And you can see that, first of all, there is a very big variation between individual East European countries in that respect. But you can see that nearly all of them performed actually better than the euro area average. So you can see that if you focus on the very left-hand side of this chart, you will see that only one country performed much worse than the euro area, that is Montenegro. And the second country on the left is Croatia, which performed about as badly as the euro area average. Why is that so? both Montenegro and Croatia, these are countries which are heavily reliant on tourism, of course. That is a very important structure of the economies. And of course, tourism was affected very strongly by the pandemic for obvious reasons. Yeah, the borders were effectively closed. There was less desire to travel. So for instance, one could see that the number of tourist arrivals in Croatia fell by about 60% in the first 7 months of the year, and in Montenegro even by nearly 80%. Yeah, so these two countries were affected the worst. But also you have a group of countries which also performed relatively badly in the second quarter, not as badly as Montenegro and Croatia, but still these are Hungary, Slovenia, Slovakia, Czech Republic. So these are the countries which are very heavily exposed to foreign trade, and especially as far as the car industry is concerned. So basically there was a very strong shock from the external side. In the second quarter, the demand for cars collapsed. Also, there were interruptions in the supply chains within the car industry. And that was a very heavy shock for these countries, for these small open economies in Central Europe. This was a very heavy shock. And this explains why they performed relatively badly in the second quarter, although there was an improvement in the subsequent months. And on the other hand, on the other hand, if you focus on the very right-hand side of this chart, you will see Belarus. So actually, Belarus performed the best in the second quarter. Why? Because Belarus was the only country which did not impose a lockdown in response to the pandemic. Belarusian President Lukashenko openly questioned the existence of the coronavirus, as we know, although in the end he contracted the virus himself. But the economic impact of the lack of a lockdown was actually beneficial in the case of Belarus. Now, it is interesting to see, I mentioned that the recessions in East European countries of East European economies were not as deep as in the euro average, in the euro area average. And this is interesting because the measures introduced, the restrictions which were introduced in East European countries in response to the pandemic were generally, with some exceptions, as I mentioned, but generally were as strict as those in Western Europe, and in some cases even stricter. So the question is, why did these economies perform actually relatively well compared, well, given the circumstances? And I don't think there is a single answer to that question, but I would like to draw your attention to one factor which played a role, and that is the fact that that East European economies are generally not as dependent on the services sector as those of Western Europe. So in this chart, you can see the share of value added in services in GDP of West European countries, which you see on the left-hand side, and the East European countries, which you see on the right-hand side. And you can see that in general, the dependence of East European economies on the services sector is lower than in Western Europe. Yeah? And all of them are below the EU average. So in this particular situation, when the services sector or large parts of the services sector were very heavily affected by the pandemic, this structural peculiarity of East European economies, their smaller dependence on services, actually played to their advantage. Now, a few words about the policy response. Of course, there has been also very strong policy measures in all East European countries, in some more, in some less. But basically, all of them reacted with fiscal policy relaxation and monetary policy relaxation. So first, a few words about the fiscal policy relaxation. In this chart, what you see in this chart is actually the size of the announced fiscal packages for this year in percent of GDP. So these are estimates which come from my colleagues, so our country experts who did corresponding estimates for individual countries. And you can see basically there have been fiscal packages in all countries, in all East European countries. On the very left-hand side, you see countries such as Slovenia, where the headline fiscal packages are very, very large. This is partly due to the fact that a large part of this package, for instance, in the case of Slovenia, is composed of credit guarantees. And credit guarantees are not necessarily an item which really result in payments. Of course, they may result in payments if it is really necessary, but a large part of it is probably will not result in payments. And that's why the announced packages in Slovenia and in some other countries, which you see on the left-hand side, are so big. Now, of course, there are a lot of different measures, a lot of different fiscal stimulus measures which have been adopted. For instance, increases in social benefits, unemployment benefits, child benefits, tax deferrals, and so on, subsidized credit. I would like to point out only one, which played, in my view, the most important role. And this was a measure which was aimed to save the labor markets. This is the so-called short-time work schemes. So these short-time work schemes were implemented in all EU member states, both in Western and Eastern Europe, in the West Balkan countries, and also in Turkey. Yeah, but we don't have good statistics for all of these countries, so I would like to focus here on the EU member states from Eastern Europe. And in this chart, or on the left-hand side of this chart, you can see the reductions in the number of jobs in the second quarter compared to the number of hours worked. And you can see that everywhere there was a very huge gap between the decline in the number of jobs and the decline in the number of hours worked. So basically the idea behind this short-time work scheme was that instead of firing people, instead of firing employees, employers were sending them into short time. So that explains the very strong decline in the number of hours worked. And for that, they were getting subsidies from the government. Yeah, so basically that is the idea. The idea was to save jobs. And those employees who are sent into retirement, who are sent into short-time work, they get only part of their salary, of course, of the wage or salary, which ranges in the case of East European countries between 50 and 80%. So this is not as generous as some Western countries. So for instance, coming from Austria, I know that in Austria it was between 85 and 90%, but still it was a very important measure which prevented a strong rise in unemployment. So there was, or there has been some increase in unemployment by 1, 2, up to 3 percentage points. But I would argue that given the circumstances, it was a relatively modest increase in unemployment. On the monetary side, there has been also a policy response. And in this chart, you can see the dynamics of policy rates of the central banks. And here, basically only those East European countries are presented, which are on flexible exchange rates. And sorry, can you please come back one slide? Which are only on flexible exchange rates. And so they still have some monetary policy autonomy, and they took advantage of the available monetary policy space by cutting interest rates. So you can see that basically everywhere the policy rates have been cut. Well, of course, the idea behind those cuts was to make credit cheaper in order to induce higher demand for credits. And in this way to stimulate the economies. So this is the classical transmission mechanism of monetary policy easing. But we can see that actually this monetary policy measure did not work so well. Yeah, so if you see at the dynamics of credit volume, to households, which you see on the left-hand side of this chart, and to businesses, so the non-financial corporations, which you see on the right-hand side of this chart, then you can see that in most sub-regions of Eastern Europe, credit expansion hardly picked up, and there have been even signs of deceleration, signs of slowdown, especially in the case of the CIS countries and Ukraine. The only big exception is Turkey. You see this dotted line, which goes sharply upwards in both charts. That is Turkey, but that was a very big exception. As I said, in other countries, actually, this monetary policy stimulus did not work as well as one could expect, or one was hoping for, rather. And basically, I think the reason was that the demand for the credits was constrained by uncertainties, yeah, and also by uncertain future with respect to earnings. Now, I'm coming to the last section of my presentation, and that is about forecasts. And of course, in these situations, economic forecasts are surrounded by huge uncertainties. Many of the factors which underlie these uncertainties are of medical nature. So basically concerning the future evolution of the COVID pandemic, of course, these medical factors are for us are difficult to access. So one can only work with scenarios. So these are not economic factors, these are medical factors. However, one thing is now pretty clear. That is the fact that the fourth quarter of this year will be bad nearly everywhere. Yeah, the reason is obvious. There have been lockdowns imposed in many East European countries, especially in Central Europe, EU member states, but also in some Western Balkan countries. Less so in the CIS countries because they care more about the economies at the moment. But it is clear that these lockdowns, they will weigh heavily on the dynamics of GDP because historical track record suggests that there is a very strong correlation between the stringency of imposed restrictions and the extent of economic downturn. And that means that many countries in Eastern Europe will record a decline in real GDP in the fourth quarter. And that means that for the year as a whole, for 2020 as a whole, we are expecting double dip recessions. So the first dip was in the second quarter and the second dip will be in the fourth quarter. Now, if we talk about the forecast for next year and for 2022, which is our standard forecast horizon, one can argue with the baseline scenario. And we take the baseline scenario as a benign scenario, which crucially assumes that the vaccine against COVID will be available or will be de facto applied to broad segments of the population by the middle of next year at the latest. And in this relatively benign scenario, we expect that the East European region as a whole will grow by about 3%, both next year and in 2022. So this is a recovery, but this is a muted recovery. Yeah. First of all, it will be not as impressive as in Western Europe, partly also due to the fact that the slump this year will be not as deep as or not as steep as in Western Europe, as I already argued. And pre-crisis levels, that means the levels of economic activity from 2019, will not be reached next year, almost in all East European countries, with very few exceptions. So we expect only for Serbia, Lithuania, and Turkey that actually they will be able to compensate the losses incurred this year, economic losses incurred this year, already next year. And one country we expect that it will be in recession also next year. This is the only country in Eastern Europe which will be in recession next year, even in the benign baseline scenario, that is Belarus. And that is basically due to the fallout from the current political crisis. And of course, the risks to this benign baseline scenario are mostly on the downside. One risk is pretty obvious, that is the uncontrolled spread of the pandemic, of the COVID pandemic. So if there is no vaccine, it is very likely that in order to contain a further spread of the pandemic, the governments will need to resort to new lockdowns, and therefore there will be new recessions. That is one risk, of course, a very big risk. And the second risk is that even in the baseline scenario, there will be a very strong need for government support measures, especially on the fiscal side. Why? Because we think, or it is conceivable, that the demand for many types of services, such as aviation, tourism, recreation, hospitality, so these sectors which have been hit the hardest by the pandemic, so the demand for these services will remain depressed even in the baseline scenario, even in the benign baseline scenario, due to the psychological scars of the pandemic. And these sectors, or many companies from these sectors, will depend, will continue to depend, at least for some time, for government support. That is one thing. And the second thing is that, of course, if there is a further spread of the pandemic, the need for government support measures will be even higher. And here, I think we can distinguish between the East European EU member states, which are expected to be in a relatively good shape from this point of view, and other East European countries on the southern and eastern periphery of the region, which are likely to be more affected, because the EU member states will benefit. So they have fiscal space, they still have available fiscal space. They should be able to benefit from their relatively good credit ratings, and also crucially from the inflows of EU transfers, especially within the framework of the newly adopted so-called Next Generation EU support scheme. Yeah. So for some of the countries, the inflows of EU transfers will be very high in the EU or for East European EU member states. But fiscal space may be a problem especially in the Western Balkans, or in some Western Balkan countries, such as Montenegro, Albania. They already have very high public debts in relation to their GDP, so they have less fiscal space. And some of the countries are also dependent on external support, yeah, in the Western Balkans, but also Ukraine and Moldova. And for them attracting, or for the governments of these countries, attracting more funds may be more difficult in this situation. If there is a risk of a premature withdrawal of government support, this will result almost certainly in further bankruptcies, rising unemployment, and income losses. So this is the risk factor. And finally, here you can see the table with our forecasts, our most recent forecasts, which our institute released about 10 days ago. So these are our estimates for this year and our forecast for 2021 and 2022. And on the very right-hand side, you see also our forecast revisions compared to May. So that was the time when we last did our forecasts. And it is a heat map. So you can see that the badly performing countries are red, pink, and the best performing countries are green and yellow. So you can see that in the baseline scenario, which is presented in this table, we expect a recovery next year and also in 2022 for most of these countries. But I would like to point out once again, this is the baseline scenario, which has crucial assumptions with respect to the ability to contain the spread of the COVID pandemic. So thank you very much. If you have any questions, please feel free to contact me. Thanks.
Vasily, thanks so much. Just one real quick question for you that I have is, here in the United States, we've seen a major delay in another fiscal package, another stimulus package. Are you seeing the same in Europe right now, in many countries?
Are you talking now about Eastern Europe or Western Europe?
Eastern Europe.
Eastern Europe.
Yeah.
No, at the moment, it was not so much of a problem. Although, as I showed in one of the charts, it was the chart with the size of adopted fiscal packages. You could see a big variation among individual countries. Yeah, and generally, you could see that the EU member states, which have more fiscal space in general, they were located more on the left-hand side of this chart, meaning that their fiscal packages have been generally larger because these countries, they can afford it. Yeah, they have generally, or many of them have lower levels of public debt to GDP. That is one thing. They have better credit ratings in general. Yeah, of course, you cannot compare the credit rating of the Czech Republic or Poland to the credit rating of Ukraine, for instance. Yeah, that means that the governments pay lower interest on their debt, which is, of course, a very important point. Yeah. So, and then on the right-hand side, you see countries such as Ukraine. I think that is a particularly good example, which did not implement a very large fiscal package simply because it couldn't afford it. Yeah, and for instance, in Ukraine, there was no short-time work scheme, unlike in EU member states and even in some West Balkan countries. So, yeah, as I said, there were measures adopted everywhere, but not on the same scale.
Okay. Vasily, thanks so much. Very informative. I know our credit union attendees got a lot out of this, and we appreciate your time.
Thank you.
All right. We turn back to Poland now for a presentation on the credit union system there from Maciej Ruczynski. He is the Vice President of NACSCU, and also Krzysztof Chmura, Treasurer and Head of Operations there at NACSCU. Gentlemen.
Sorry. Warmly welcome our friends and colleagues from credit unions. My name is Maciej Ruczynski. I am Vice President of National Association of Cooperative Savings and Credit Unions in Poland. And I would like to say today a few informations about our credit union system in Poland. Next slide, please. Our first credit union was established in 1992 in Poland, and in the same year that credit union begins its operations. There was no specific law on credit unions, only one article in trade union law. Credit unions were operating only on the base of occupational common bond, usually between employees and one or few companies like shipyards, coal mines, hospitals, etc. Or one occupation, teachers working in schools or certain state administration unit. In 1996, the Credit Union Act becomes effective. The law allows organizing CUs also with organizational common bond for members of different social organizations like associations, societies, and, for example, trade unions. And in 2012, New Credit Union Act was established. It was a state regulation, and we received a deposit guarantee. Deposits in Poland are guaranteed to 100,000 euro now. Next, please. The Polish credit union system model, the adopted model of credit union is based on diversified membership, various types of bonds between members, and multi-branch organization structure, offering wide range of various services. This model is characterized by high ability of adaptation to changeable market conditions and by economy efficiency. It provides answer to the needs of contemporary society, thanks to standardizing of documentation and procedures, consumer interests and appropriately protected, and the activities of credit unions are pursued in a unified, safe manner and according to the rule of law. The structure of the credit union system in Poland is composed of three main parts. First are cooperative savings and credit unions, and the second is National Association of Cooperative Savings and Credit Unions, and also organizations and subsidiary companies owned by our system to support shared services and development. Next slide, please. And sorry. Next slide is for Chris.
Hello.
No, we should turn back to the previous slide.
I would like to show credit unions provide access to financial services to common people, enabling them to meet their goals and improve their economic and living conditions. Credit unions are not for-profit institutions based on the idea of financial self-help, cooperative values, international credit union principles, ethical economy, and corporate social responsibility. Credit unions make up an integral part of Poland's formal financial sector, regulated and supervised, well established within legal system.
Now a few information about services provided by credit unions.
I would like to about credit unions in Poland provide services such as term deposits, credit and loans, accounts, internet and mobile banking, debit cards, payment settlements, insurance services, investment fund product, and we also cooperate with companies which manage investment funds. Next slide, please. This is a little summary of Polish credit union market. There are 23 credit unions, when almost 1.4 million of members and 652 branches. Total value of assets is $2.4 billion. Customer deposits $2.2 billion, and loans to members $1 to $6 billion. Own funds 115 million, and solvency ratio are 6%. Okay, that's all from me. So, next.
And now my slide. Let me tell about National Association of Cooperative Savings and Credit Unions and our target. National NACSCU has to ensure the financial stability of credit unions. It's the most important role of NACSCU. And also provide financial support to credit union from the funds of the stabilization fund. The next is control over credit union to ensure the safety of their savings and compliance of credit unions' activities with the provisions of law. Our activities of during the COVID-19 was first of all to ensure remote contracts for members. We prepared for our credit unions, activation of mobile system and internet services. We implement pay by net payments, which enable our members to pay to establish payment in internet to internet shops. We support in the area of issuing payment cards. It was a very dynamic process, particularly at the end of first quarter and beginning of the second quarter this year, and lowering payment fees for members and credit unions. Next, please. In 2019, we prepared development strategy for nearest 3 years, and I would like to present you main goals. First is digitalization and development of electronic services, provide simple and clear financial services for our members. The second is redefining the function of the NACSCU to improve and more fully meet the expectation addressed to it by the cooperative savings and credit unions. And next is improve financial education and optimization of the operating model of NACSCU. Okay. And a little about our structure.
Yes, now I would like to introduce organization and subsidiary companies owned by credit unions. We have Credit Union Mutual Insurance Society, Credit Union Life Insurance Society, Applet Limited, it's IT company that are making software for credit unions. Cardera Limited is a card processor, and Apella, this is a media company. The main task of Saltus companies deliver insurance such as property, wealth, life, health, transportation, travel, loans, and retirement. Next, please. Applet is IT company is designated to development of software matching to the ongoing development of the credit unions, SCOCOM. Internet banking, Applet is administrator of the ISCOC website. Mobile banking, the same as above. Service of workstation and user support, service desk. Administration of telecommunications, hardware creating, data storage, and servers. Cardera Limited, the main roles of Cardera are card processors, provides call center services for credit unions, and international money transfers. The last one, Opera Media Company, they are operation on a media market, and their main goal is to provide marketing campaigns, managing public relation, publishing, creation of multimedia, organization of events, and web services. Okay, thank you very much for attention. Maybe Maciej will continue.
I would like to thank you. If you have questions, please ask. Thank you very much. Do zobaczenia.
Thank you very much.
And thank you, Maciej and Krzysztof. Good overview of what NACSCU is all about and what you offer to your members there and your credit unions there. And finally, today we are joined by Rafał Boguslawski. He is the Director of Strategy and Development and Savings Products at Analizy Online SA. He's got a presentation for us on COVID-19, European financial markets, and the economy from crisis to opportunity. Rafał?
Yes, hello. Is everything okay?
Yes.
We can hear you. We can't see you yet.
Okay.
It is, you have the floor, Rafał.
Yes, I see. It was a small technical problem. It's okay now, I'm sure. Okay.
It's okay now.
I'm Rafał Boguslawski. I work for the company Analizy Online. It's a company that delivers information about the Polish mutual funds generally, but my almost whole professional life is connected to financial markets. Since 1991, I was a strategist, market strategist. I was the fund manager, and I know that if we are talking about the financial markets and the economy, especially today, everything is connected. And the most important part of my job is to find connections between the fact of between the issues that happened, because we know what happened, but we don't know what will be the impact on the economy, on the financial markets. Of course, we know what happened on March or April, but now we are in the period that it's, I think that it will be the big shift. I say during presentation many times that it's like earthquake in the economy and financial markets, because the impact of COVID-19, it will be not only next year, it will be next 10 years that the economy will be impacted by that pandemic. When I start with showing some results of my work, I would like say about the presentation, because I would like to say a few words about the global shock, because it happens something like I've never seen before, especially in March and April. It was the incredible volatility on the markets, and the slump in the economy was much bigger than in 2009, and it was the biggest slump in the economy since the Second World War. Economy and financial markets, as I said, they are connected, and we see that very often the problems on the financial markets are connected with the problems in the economy. But sometimes, like in 2008, the problems in the financial markets could cause the problems in the real economy. Of course, it was the problem with housing market in the US, but it was spreading around the world. And economic outlook, I would like to say a few words about the European economy. I would like to say a few words about the situation in Europe, but of course, it's almost impossible to say something interesting about the European economy and European financial markets without saying something about the Asia countries or United States, because now I think that the most important part of the future will be created by changes in the global way of thinking of doing business. And I think that it's really important that we should know what will happen if we take into account the capital flows. And I think that it's next 2, 3, 4 years, it will be really big moves if we are talking about the capital flows. And risk and opportunities. Each crisis is, of course, the risk. I think that it will be a lot of problems for companies that are connected with old economy, but some of these companies will survive, and probably it will be the good opportunity to build the new branches in the economy. I think that it's the view of that it's important when we start to say about the economy and the financial market, that everything is connected. For me, it's the most important thing that we should remember, that Poland or any other country is not alone, and relative performance of the equity market shows that it's important to take into account that, for example, new technology now, it will be a much more exciting sector than the old economy, like oil producers. And when I wanted to show what happened during the March, I take that chart, because it's the chart that, of course, it's connected with US equity market. It's Fear and Greed Index, and of course, it's when we look at what happened during the beginning of 2020, especially in February and March, we see that it was a big slump. And it means that when we have such big slump on the equity market, that it's high level of panic. And there are 7 factors that it's taken to construct that index. One of them is market momentum, junk bond demands, safe haven demand, and when we see what is going on during that period, when we have during such period, when what we have in March, we see that it was really fast, and I think that it's never happened before. I spent almost 30 years on equity markets, general and financial markets, and I've never seen something like that before. It was the few records because the pace of slump equity market was much faster than anyone before. Even 30s, last century's 30s, the slump wasn't so dynamic. And of course, when we see the equity markets, it's important to understand it's the last 8 years. Advanced economies, the red line shows that some kind of volatility appeared during that period. Of course, it was 2015, 2016, the time when we have problems with manufacturing sector. But in 2019, it was especially the end of 2019. It was the end of 2018. It was the problem with Fed policy, that they wanted to withdraw from the monetary stimulation, and it increased the volatility on the equity market. And of course, emerging markets economies is the same situation, because if you look what is going on around the world, if you look at the equity markets, they are connected. The correlation is higher and higher, and let's say that 15 years ago that correlation was lower, 25 years ago it was much lower. Now most of the equity markets are connected, and correlation is high. And in March, that the slump on the equity market was incredible, and it was never before happened that Standard & Poor's, the main U.S. equity index, after achieving a top 2 weeks later was 10% lower, and it happened first time in the history. Why it happened? Because most of the investors are really scared, because at the beginning of 2020, it was the main view of investors was that we have a quiet year. It's probably that with better situation, the European economies, probably with the better situation in the United States. Most of the economic indicators show that it could be a nice year if we take into account the state of the economies. And it was a lot of positive bets on the markets, and because of that, when the economy had a problem, the slump on the equity market was incredible, amazing. And it was the same, almost the same situation on the bond markets. And when we look what happened with government bond yields, sovereign bond yields, we see that during the March, emerging market economies, average bond yields were growing up rapidly, and it was the first wave of shock. In the United States, thanks to U.S. Reserve Federal Bank reaction, it was for 10-year bonds. It was the period that yields were lower, and still so they are lower than any time before. And yellow line, it's Italy, and it was important for the investors that how a risky period of time it was. At the beginning of March, Christine Lagarde said that Christine Lagarde, the chairman of the European Central Bank, said in interview that it's not the role of the European Central Bank to keep yields at the low level. It was the second wave of panic on the Italian bonds market, and 2 or 3 days later, Christine Lagarde told that it was misleading, and European Central Bank started to pump money in the financial market. It was incredible reaction of the central banks, American Central Bank and European Central Bank, but most of the central banks decided to do the same activity. And of course, German market, German bond yields, it was almost flat compared to the other markets, because German bonds, German sovereign bonds are generally 10 years bonds are with negative rates, and it's problematic that European Central Bank is not able to lower that interest rates, and because German sovereign bonds has yield in the minus territory, it's really difficult to see any further reaction on that market. But it's interesting that if we take into account what's happened on the US sovereign bond, it was the period, especially the first part of March, when that market was almost frozen. It means that almost, maybe not frozen, but paralyzed, because investors are afraid to buy and sell bonds, and thanks to really strong reaction on Federal Reserve, and that liquidity appeared again. But it was the moment that even in the United States on the sovereign bond market, it was problem with liquidity. And when we see what happened on financial markets during March, we see that central banks are well prepared for that situation. It means that I think that it's a lesson from 2008 that let's say that reaction was similar that the period of time, much longer period of time was needed to react in that way. In March, the reaction was incredible. Federal Reserve decided to increase balance sheet by 3 trillion US dollar during the period 6 weeks it took to increase by 3 trillion US dollar balance sheet, and European Central Bank decided that they pump into the market more than €1 billion, and it was really fast reaction. It was necessary to calm the market because like in 2008, if without that reaction, we could have a problem with liquidity and psychology, especially in the globalized economy, is really important. And I think that thanks to central banks, we still have an opportunities, not only the risks. And when we see what happened during the second quarter, on the previous presentation, we saw that in Central Europe or in Europe, there are differences between countries, but it's interesting that if we look at the global situation, there are a few countries from Europe that lost almost 20% of GDP during the second quarter. United Kingdom is an example that that economy had a big problem with pandemic, and of course it's a few reasons why it happened. But when you look what happened with many countries, it's a problem that especially in Europe and Latin America, there was a lot of problems with pandemic. Of course, the situation in China was different because China was the first country that had problem with pandemic, and the reaction was really fast. But it's interesting what happened and what kind of reaction was needed to keep economy alive, and of course to cope with pandemic. And next slide, it's a few remarks about differences across continents in COVID-19. Generally, Far East has done the best. Maybe Africa has done the better than expected, but when you look what happened in Far East, I think that then one of the most important factors is that cultural willingness to wear masks, or generally willingness to follow rules or orders. And that means I think that it's not only the China, but I think that South Korea is the same situation in Japan, that people wanted to follow rules, and it was the first reaction that they took that orders seriously, and they decided to follow the rules. And of course, experience with epidemics, because Asian countries has had much more opportunities to test the system, because of the even now this century it was the two epidemics, and the governments were better prepared for that situation. In Africa, it's interesting because, of course, it's one of the reasons that Africa has done better than expected is young population. Only 3% of population, African population, is above 65 years old. But it's the same situation like with Far East countries. African countries are well prepared for pandemics, and especially Ebola 2013, outbreak of Ebola 2013-2016. It was the period when they were forced to prepare health system to cope the epidemic. Latin America, it was almost disaster if we look especially in March and during the summer. And the main problem is that people from villages migrated to the cities, big cities, and without any control. And of course, in a adequate public health system, it was the problem for for the number of deaths in that countries. And Europe and USA, I think that the main problem was the same. At the beginning of the pandemic, governments downplayed COVID-19, and it means Donald Trump, who had jokes about the pandemic, Boris Johnson the same, and that countries, especially European countries, decided to treat that risk as not so important, or it shouldn't be so painful, but it was a mistake. But in March, most of the European countries decided to take action, especially when we saw what happened in Italy. And next slide, I think that it's important to show what is going now. And we look in the middle of screen that we see that that points, pink points, that active cases in North America and Europe and most of the Latin America countries are much higher density than in Africa and in Asia. I think that it's differences in the policy that government decided to approve, and of course it's a problem that during the summer in the United States and in the most of the European countries, government decided that the worst is over, and it's now we pay for that. And it will be important if we are talking about the future of the economy in the European countries and generally in the United States too, some African countries. But of course, for me, the most important is what is going on in European economies and European financial markets. And I think that I would like to say a few more words about the policy that is implemented in that countries, or generally in countries who try to cope with pandemic. Next slide, it's about the situation or the kind of decision that have to be made by governments, because that recession on what we have the second quarter this year, for sure, it was the recession. The fourth quarter of this year, probably most of the countries will have recession. It means that this year it will be a year with negative growth rate of GDP. But that recession is different from the recession that I analyzed during my 30 years of professional careers, because it's the first recession that is made not by the financial markets, by cycles, economical cycles, but by containment policy. It means that government decided to stop the economy because they wanted to save lives. And of course, it's hard to say what kind of reaction could be proper, because especially in March, no one knows how deadly is the virus. For example, now we know more about the spreading of virus, but still there is a lot of problems with finding the reason why some people are more exposed to the dangerous illness than others. But the upper part of the chart shows that new cases, the red line, without any intervention from the government, could be much higher and much faster growth than we have that blue line when we have a containment policy. And it was decision due to because the government decided to save people's lives, because the hospitals or generally health system were not prepared for that high level of new cases. And it means that some people could have no help, and the level of death cases could be much higher. But because of that, and because of that reaction, we had, and it's a down part of the bottom part of the chart, we had a containment policy that caused recession. And thanks to reaction of the governments, that recession could be lower than without the fiscal stimulation or without the support from central banks. But despite of the reaction of the governments, now almost for sure, because of course it's not the end of the year, we have the deepest recession since the Second World War. And it's of course the big problem and big challenge for the global economy, because that recession is synchronized. It means that most of the countries have the same problems with the economy, and it means that these countries who has much more space for fiscal stimulation, for example, will have much better opportunity to survive. And it's the old true that the winner takes a lot, much more, or everything. And when I'm looking on the European economies now, I think that Germany is a country that, thanks to fiscal stimulation, that they have space and they pay really low interest rates. Sovereign bonds, German sovereign bonds have negative yields, and it means that it could borrow money from the capital market, and they don't pay for that. They are able to use that capital to support the economy. For me, the most important part of that chart is not what happened now, what happened in 2020, but what will happen in 2021. And the problem is, I see that the tension between developed countries and developing countries, and if we are talking about Europe and especially Eurozone, there are countries that they are divided, okay, because Spain and Italy need a lot, much more support than Germany. But if we are talking about Europe, I think that it's true that countries that are the part of the European Union have a better position to survive that pandemic. And it will be a problem for global economy, because with countries that have a lower level of income or lower ratings, it will be difficult to cope the pandemic, and they could lose the part of the market during the next 5-10 years. It's not a problem for the next year. It's a problem that now most of the countries are building position for the next 10 years. If we lose that challenge, if we lose that race, and we are not prepared for next year in 2022, 2023, probably the part of global economy will be much more connected with developed economies. It's one of the risks that it's important if we are talking about the future of the economy, of the global economy, and we are talking about generally about the Europe, and especially that East Europe countries need much more support from international financial institutions. IMF, it's one of that institutions, but I think that most of the people who decide about that policy realize that it's important that kind of support that is needed, especially for low-income countries, is now much more important if we are talking about the future of the global economy than what is going now during the pandemic. And next slide is, of course, situation is different from the situation in 2008, because during that period, if we are talking about the economic policy and monetary policy, before 2007, 2008, we had a period of much higher interest rates, and it means that most of the biggest central banks, Japan is they have their own policy, and it's because what happened at the beginning of 90s and the problems with the economy, the policy of interest rates at zero level. It was from more than 20 years. But if we are talking about the Eurozone, United States, United Kingdom, there were space to cut interest rates. And in 2020, only US Federal Reserve had space to cut interest rates. The US Federal Reserve, US Central Bank, it was the only big central bank who decided to reduce the QE, it means quantitative easing, and they wanted to increase interest rates to build the space for the situation that we have next shock. Because of course it's I'm sure that it's not the last shock that we had in the economy. I know that the truth is that what we can avoid is taxation and debt, but I think that crisis it's the next thing that we couldn't avoid, and I think that crises it will be the part of our future, but we don't know now what kind of crises will happen. But now it's a problem with the biggest central banks, that they have no space for further decreasing interest rates, because they are so low that it's impossible, especially in the United States. Of course, there are support the decision about the decreasing interest rates to negative level, but I think that the risk of that decision could be enormous. And it means that for me, the world financial system could be in jeopardy with US decided to cut interest rates to the negative territory. But because of that low of level of interest rates, now we have the kind of support that is unconventional. It means the QE, and it means that US Federal Reserve is buying bonds, and they pump the money, capital, not only in the financial markets, but to the real economy too. And it means that they support households, small companies, and that that kind of support is, of course, it's European zone is possible too, and it means that it's important for central banks to agree that they don't care about inflation, but they care about the economy. Next slide. It's important for the level of financial support for the economy. I took a few information about the level of that support, and of course it's there are trillions of dollars, for more than $4 trillion, and it's a level of support for European economies. It's important, as I said, because the time that decision was made, and it was possible to get that money for the companies that, especially during the second quarter, they needed that money. It was really fast, and I was surprised that the European Union was able to decide in such fast pace about the help for the economy. Thanks to that, we now have situation in the European Union countries that most of the countries, it's not it's not a really bad shape. Of course, there are problems, but generally, without that support, it could be much more worse situation. Of course, it's important to remember that European Central Banks decided to create more than trillion euro, 1.3 trillion support in form of quantitative easing. And I would like underline once again that it's important that we have the situation that is really dangerous for the future of the economy. It means that advanced economies are able to borrow money and really low level. It means interest rates are low than was even 10 or 12 years ago during the big financial crisis. Middle-income countries, low-income countries, they need much additional help. Of course, it's really hard to help that countries because we had capital outflows from the emerging markets. It was a kind of risk off during February. We had downgrades of sovereign debt, especially that middle income and low income countries. Now, I think that the most important part of the solutions for the global economy is to help that countries. And it's important for international financial institutions to remember that not only the big countries are important. And the next slide, it's important for me that in Poland, what is the situation now in Poland? If you look, there are chart about the new cases in Poland, and when in March we had a full lockdowns. If you look the level, how many new cases was in March, we see that it was almost nothing. Now we had more than 25,000 new cases, and next slide we'll see what will happen in the economy. It's a PKO tracker. It's a Polish bank that economists decided to use fast economical data. For example, payments, credit card payments, or the level of traffic, and we know almost online what is the economical activity in Poland. And we see that during the April, it was a terrible slump. Now we have the second lockdown, and that slump in activity, it's hard to say that it's a slump. It's weaker growth, but weaker activity, but it's not so bad. And I think that even if that lockdown will be longer, it means that the Polish economy will survive. And next slide, it's important to see that if we are talking about the GDP growth and forecast for Euro area, for example, most of the economists decided that it's fourth quarter, it will be a slump, but much lower. But first quarter next year, probably second quarter, it will be much more positive situation in the Euro area economies. It's important, but especially for Poland or countries that are connected with Germany, because Germany is an engine for the European economy, and I think that thanks to space, to the fiscal stimulation, it will be the next 2 or 3 years when the German economy will be that engine again. And the next slide, it's the positive message for I would like to ask before one, yeah, for Euro area and generally European countries and US, that vaccine will be much more positive, will have much more positive impact on the Euro area economies or US economies than China, of course, because that the fact that China now it's the it's in the better situation when we are talking about the pandemic. But of course, it's not the, as we see, the positive impact on the economy will be in the second quarter, probably the second half of next year. And it means that we need, especially now and especially at the beginning of next year, we need in Euro area and European countries, we need more and more fiscal stimulation. Without this fiscal stimulation, we could lose everything what we gained during the positive reaction at the first half of the year in the second quarter. And next slide. It's a few doubts about the future. Now the consensus is that low interest rates will be given forever, especially for the biggest central banks. But I think that there could be a few problems because I agree that most of the central banks are at the point with no return. And it means that US Central Bank, European Central Bank is not able to cut interest, to increase interest rates, and probably will keep interest rates at the low level for the next 5-6 years. But it could be a problem that I show on the next slide, that inflation could be the really big surprise. We see that during the recession in 2009 and 2015, the prices in global trade export prices were much lower than they are now. And probably that is a situation that due to changes in the supply chains and distortions in the supply chains, that the prices in the global trade export will be much higher, and it could be positive impact on the inflation, especially in the United States. European Union has problems with deflation, and I think that it takes more time to cope that. But in the United States, it's possible, and in the emerging markets, it's possible that inflation will be high, and it could be real threats for zero-level interest rates in the United States. Next slide, it's about the GDP slump in 2020, rolling 20s. Of course, it's 1920s. Right? It means that there are the period when the economy was last century. The economy was booming, and of course, it's one of the reasons that I'm still optimistic about the future of the economy, because after that shock, like in 2018, it was the pandemic Spanish flu, and the situation is similar. Maybe not, it's not the same situation, but it's similar. And I hope that during 2022, we'll see that the future is much brightness that it seems now. Next slide is about the risk factors for optimistic scenario. If we have long-lasting lockdowns, it could be much more negative impact, especially during the next year. But I hope that vaccination, it will be possible at the first or second quarter of next year. And I think that with that fiscal stimulation that is needed in 2021, and I think that even the countries that now have problems with the debt level should spend more money, because without spending that money, they will have problems in 2022, 2025. They could lose the future. And of course, it's easy to say that, but I think that it's really important. And I think that international financial institutions will help that countries, because without stimulation, it will be really hard to rebuild the economy. Political risk, and there are many political risks, and one of them is recently Poland and Hungary decided to veto budget because they don't want to agree on the regulations about the justice. And I think that political risk is much more than we can say now. But I think that thanks to the reaction of the 2020, that most of the countries decided to cooperate, I think that that political risk will be lower, maybe not on the line between China and European Union and the United States, but probably it's not will be so important like lack of fiscal stimulation and social unrest. And I think that people are tired, and we see it in London, Spain, Italy, that people protest against lockdowns, and I think that it's a risk for the economy. We see that second wave and fiscal stimulation is important because most of the countries now shows that economic activity is weaker. But I think, as I said, that with the help of financial institutions, central banks, and politicians, we cope that period of lower growth, and next year will be much better. Next slide. It's almost the end of the presentation, because I would like to show that the new world of energy, it's our future, especially in the US and European Union. We have no return to the fossil fuels, and I think that's opportunity for everyone who wants to be on the growing wave of innovations. And I think that it's a real it's a chance for the future of the Europe generally, because we could be, as a continent, we could be a leader if we are talking about the green economy. Next slide. It's a few words about the budget, European Union budget and next generation budget. Of course, there are a few important part of that budget, but it's important that first time European Union decided to cooperate to borrow money for the whole for the all members of the European Union. Next slide. It's important for to understand that during the earthquake, it means during the pandemic, we saw that private sector is more flexible than public sector. I think that now, especially in European countries, no one is able to say that public sector is more effective. Private sector is able to cope challenges much faster, and in much better way than public sector. Just-in-time delivery has limitations. It means the supply chains are problems, and most of the companies are now, they have to take into account that maybe cooperation with China is not the best solution. There will be a lot of changes in that strategy for the biggest companies, international companies. Remote work is possible for the wider group of people, and it's a surprise, of course, that everything what seemed to be impossible, it became possible in 2 weeks or 3 weeks, because I saw the companies that changed the strategy or way of activity during the 2 or 3 weeks. And of course, importance of clear communication. Each country that without the clear communication has problem because people don't believe, and it's management of information, the next part of the future. And new supply chain optimization. I think that, as I said, it's the most important thing if we are talking about the future. It's a chance for the European countries, especially middle or low income countries, because that cooperation will be necessary for the biggest European companies, and probably it won't be China. Flexibility has value. It means that it's important to think about flexibility of the company, of the business, and sometimes it's better to pay more, but have the chance to change the way as we run business. Digitalization, it's a future, and I think that especially in the financial service, it's a future, and I think that in 5 years we'll have almost 50, 60, 70% of services online, and it's no return from that process. And the green revolution, as I said, especially for European countries, it's our business future, and we should look for that opportunities. And I show that Dow Jones Industrial Index. I thought about European indexes, but I think that it's a really important information. We had since the beginning of last century, World War I, Spanish flu pandemic, Great Depression, Second World War, influenza pandemic, US inflation, dot-com peak, global financial crisis. And I think that if we look at that period of turbulence in the economy and financial markets, after each of that period, we made a big progress as a civilization. And I think that now it's a big opportunity for the future. And everyone who is able to use that opportunities will be the winner. Everyone who wants to keep the old-fashioned way business, old-fashioned doing business, will be punished. And I think that it's a message for that guys who think that it's the end of the world. I don't agree. I think that there are much more opportunities, but it's really hard to be enough fast. I think that now more and more things in business will be faster and faster, and it's a message for the next 5-10 years. 20s will be an exciting time. Thank you very much.
Rafal, thank you. You're the second economist this week who has looked at this issue and noted that there needs to be coordination to ensure that the global economy is stable. I wonder how confident you are that there can be that coordination. And when you say coordination, do you mean between OECD countries?
And I think that it's OECD countries, but generally I think that more and more institutions should be cooperating, because without the cooperation, it will be really hard to stabilize the economy. I think that the main problem for the next 5 years, it will be that not only the low-income countries will be in the losing position, but low-income people or households will be in the worse shape than people who are well paid, because it's much easier for people who are well paid to work online, for example. There are much more abilities to use the chance that COVID gave. But if you are talking about low-income households, it's a big problem. And I think that basic income, it's one of the solutions that could appear, especially in Europe. But without the cooperation between countries, it will be really difficult to achieve that. And I think that the tension in the society is the biggest problem that the economical slump during the 2020.
Well, thanks so much. And we know that it's crises like these where credit unions tend to be there for their members, much more so than the large banks are. And we know that our credit unions in Poland and in other countries in Central and Eastern Europe are going to do their best to try to make sure that their members are taken care of and that they have access to the funds they need and the loan products and other tools that they need. Thank you so much, Rafal. And I want to thank everyone else who has joined us today. Rafal Matuziak, our board chair and CEO of NACSCU, and all of his employees who joined us, as well as Vasily Astrov, who is, of course, with the Vienna Institute on International Economic Studies. Thank you so much for tuning into our presentation today. This will be made available online. It will be made available online on the World Council YouTube channel. That's at youtube.com/WOCU, youtube.com/WOCCU. You should be able to find that later today on our YouTube channel. Thank you so much for joining us.